Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on the presentation of financial statements. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations. This webcast discusses the presentation of financial statements, and in particular how the needs of readers of NPO's financial statements may require different presentation and disclosure approaches to those used in the private and public sectors. A particular factor for NPOs is the degree to which funding is provided through donations, which may include restrictions on the use to which those funds may be put. Consequently, the concept of fund accounting, which is not a common feature in either the private or public sectors, may be relevant for NPOs. We begin by looking at the scope of what we mean by the presentation of financial statements for this session. Next, we will consider the main issues that NPOs face, and then look more in depth at fund accounting. We will then look at how these issues are currently addressed in the existing accounting standards, beginning with the international standards, before looking at how some national standard setters have addressed NPO-specific issues. Finally, we will look at the alternative treatments identified in the consultation paper. The financial statements provide information to a wide range of stakeholders. They provide information about an NPO's financial performance, financial position, and cash flows, and are a key document for holding an NPO to account and for making economic decisions. The nature of an NPO's operations will affect the information stakeholders are seeking. Factors that can influence the information needed by stakeholders can be grouped as follows. Firstly, information that provides transparency about an entity's funding, and in particular, whether that funding is available for the entity to use as it sees fit. An entity may not have discretion to use funding as it sees fit, where that funding has been given subject to conditions or restrictions. The accounting for these types of transactions is discussed in the non-exchange revenue presentation. However, ensuring any limitation on the use of the funds is transparent in the financial statements will help stakeholders and decision makers. Similarly, some donations may be in the form of an endowment which must be invested. While an NPO can use the interest earned from the investment, the capital itself cannot be used by an NPO. Again, ensuring this limitation is transparent in the financial statements will help stakeholders. Secondly, some stakeholders may have specific information requirements. For example, they may be seeking information about an NPO's use of donations. They may be seeking supplementary information about a particular project to which they have provided funds, or they may be seeking information about how the NPO manages its reserves. A question to be considered is the extent to which such information is appropriate in the general purpose financial statements, which are intended to serve the needs of a wide range of stakeholders, rather than the needs of individual specific stakeholders. Stakeholders may also be interested in how the NPO has used its resources. Disclosing major categories of expenses can help with transparency here. This is discussed further in the separate presentation on the classification of expenses. Building on the issues identified in the previous slide, this slide highlights some key issues with the presentation of general purpose financial statements. General purpose financial statements are necessarily an aggregation of an entity's transactions. Financial statements result from processing large numbers of transactions or other events that take place in a financial reporting period. It is highly unlikely that an individual transaction will be identified in the financial statements, although exceptions might include, for example, the only sale of a building or the only receipt of an endowment in a year. Different stakeholders may have different views about the information that should be presented. Attempting to provide all the information stakeholders may wish to see in the financial statements may lead to complex, costly requirements. Providing varying perspectives on the same transactions may also confuse users of the financial statements. So, it will be necessary to consider the extent to which stakeholders' differing views can be accommodated in general-purpose financial statements that are intended to meet the needs of many stakeholders. Balancing the competing needs of different stakeholders must be considered. In particular, it should be remembered that general-purpose financial statements are prepared from the reporting entity's perspective. This means that financial statements will reflect the reporting entity's accounting policies. Classifications of assets, liabilities, revenue and expenses, and materiality judgments will be based on the entity's overall operations, not the subset of its operations that may be the focus of an individual stakeholder. Some of these different perspectives might be addressed by fund accounting, and we will explain this further on the following slides. Alternatively, stakeholder needs could be met by a cash flow statement that shows the source and application of funds. The preparation of a cash flow statement, separated by fund, analysing receipts and payments for each fund, could meet the needs of stakeholders who want to understand what has happened to their donation. It would require all cash receipts and payments to be recorded by a fund, which may be challenging because of system limitations, cost, and effort. There is also the question of whether this is appropriate for general purpose financial statements that are intended to be used by a wide range of stakeholders. Disclosing the accounting treatment for donations that have conditions could assist users. Some donors may expect an NPO to recognise revenue for the donations they have made and may be confused or worry about what has happened to the funds they have provided if they are not able to see this revenue in the income statement. Linked to this, timing issues could be explained in the notes to the financial statements. Where a donation has been recognised in one financial year, but the related expense doesn't happen until a subsequent financial year, users may not understand the misalignment between these transactions. Fund accounting requires an entity to maintain separate financial statements for each type of fund or reserve. The financial statements used in other sectors often present the financial statements as a single column, as in this example. When an entity uses fund accounting, additional columns are presented for different types of fund or reserve. This example shows two additional columns, one for restricted funds and one for unrestricted funds. Restricted funds are those funds given by donors with the condition that they are used for a specific purpose. Unrestricted funds may arise from general donations or an entity's commercial activities and can be used for any purpose. So an environmental NPO may have a restricted fund that can only be used for the purchase of a new site, and an unrestricted fund that can be used to fund the NPO's ongoing activities. Presenting each fund or reserve may be feasible where an NPO has few restricted funds. However, as the number of funds increases, so will the complexity of the financial statements, which may make them more difficult to understand. Aggregating funds into similar types of fund or reserve could help and is likely to be necessary in the financial statements of most NPOs if fund accounting is adopted. A key benefit for stakeholders of fund accounting is that it increases transparency. Stakeholders will be able to distinguish between restricted and unrestricted funds and will therefore have a better understanding of the resources available to the NPO to fund its ongoing operations. The income statement generally lends itself to a fund presentation, and the financial position statement, balance sheet, could show the fund balances separately. Disclosure of an NPO's policies on reserves more generally may help stakeholders understand management's decisions. If an NPO decides to set aside other amounts for specific purposes for internal management reasons, reporting these separately from an NPO's other finances can provide greater transparency about an NPO's operations and the amounts available to fund its ongoing operations. Offsetting these benefits is the additional complexity introduced by fund accounting. For some NPOs, introducing fund accounting may increase costs, particularly if systems need to be updated. While the income statement generally lends itself to a fund presentation, and the financial position statement balance sheet could show fund balances separately, presenting fund balances for assets and liabilities could be far more challenging. Some suppliers, for example, may have carried out work that is charged to the NPO's restricted funds, and some work that is charged to the NPO's unrestricted funds. If the financial systems only report the total amount owing by supplier rather than cost centre, separating the creditor balances may be time-consuming. Finally, entities will need to consider whether some funds are separate reporting entities. There is a separate presentation on reporting entities. IFRS and IFRS for SMEs have the same requirements for the presentation of financial statements. Both require an entity to present a statement of financial position, a balance sheet. Entities present an income statement and a comprehensive income statement. These can be separate statements or combined in a single statement of comprehensive income. Entities also present a statement of changes in equity, a statement of cash flows, and notes to the financial statements. The requirements in IPSAS are similar, although different terminology is sometimes used. Entities present a statement of financial position, a statement of financial performance, which is equivalent to the income statement under IFRS and IFRS for SMEs. This statement does not include items that are classed as comprehensive income under IFRS and IFRS for SMEs, for example, revaluation gains. Instead, such amounts are presented in the statement of changes in net assets equity. Entities also present a cash flow statement and notes. All three frameworks include guidance on materiality, on the aggregation and disaggregation of items presented in the financial statements, and on the different classes of assets, liabilities, revenue, and expenses to be presented. However, they do not include guidance on fund accounting, the presentation of fund or reserve balances, or the disclosure of fund or project statements, which could be important to NPOs. Turning to the national standards, one jurisdiction has standards based on IFRS. While these offer reduced disclosure requirements for NPOs, no guidance is provided on fund accounting, the presentation of fund or reserve balances, or the disclosure of fund or project statements. There is a jurisdiction that uses the IFRS for SMEs standard. This jurisdiction provides sector-specific guidance for NPOs. NPOs are required to use fund accounting in their financial statements. In presenting the financial statements, funds are aggregated into three classes: unrestricted funds, restricted income funds, and restricted endowment funds. In the income statement, columns are used to show the income and expenditure for each class of fund. The three classes of fund are shown in the statement of financial position, with a columnar presentation permitted but not required. Transfers between funds are included in the income statement. There is also a jurisdiction whose standards are based on IPSAS. It issues simplified requirements for smaller NPOs. These requirements provide guidance on the difference between restricted and unrestricted funds, referred to as reserves. However, the minimum reporting requirement is that an aggregated figure for reserves is presented in the statement of financial position. One jurisdiction has developed national standards that are not based on international standards. Net assets that have donor restrictions and net assets that do not have donor restrictions, equivalent to restricted funds and unrestricted funds, are presented separately. In the income statement, income with donor restrictions is shown separately from income without donor restrictions. Where an NPO satisfies the conditions imposed by the donor, the net assets are reclassified as net assets without donor restrictions. The related expenditure is shown as a decrease in net assets without donor restrictions. Another jurisdiction has developed national standards that are not based on international standards that permit but do not require the use of fund accounting. The standard requires a statement of changes in net assets. Within this, the standard requires the presentation of four different classes of net assets. These are endowments, internally restricted net assets, which as discussed are amounts management wish to put aside, for example, for a capital investment, externally restricted net assets, other than endowments, and unrestricted net assets. Under this standard, restricted contributions may be accounted for using the deferral method, where revenue is deferred to match the expenditure, or the restricted fund method, which uses the fund accounting method we discussed earlier. All of the alternatives proposed take the minimum requirements of international standards as the starting point. They permit flexibility in the presentation of the financial statements, for example, whether a vertical presentation or horizontal presentation is adopted for the balance sheet. This flexibility is retained in all the alternatives. No prescribed format is proposed. However, more guidance is proposed in all of the alternatives for NPOs regarding the presentation of net assets or equity. The presentation approach chosen will depend, at least in part, on how contributions with restrictions are recognised. The recognition alternatives are discussed in the presentation on non-exchange revenue. So, Alternative 1 is to retain the requirements in the international standards, IFRS, IFRS for SMEs, and IPSAS, unchanged and provide supplementary guidance. This guidance could cover how additional information would be included in the financial statements that could be relevant for stakeholders. This could include disclosures on restricted funds. Alternative 2 is built on the IFRS for SMEs standard and draws on guidance from national standards, specifically around the use of fund accounting. This alternative requires the use of fund accounting and would require as a minimum that income is split between restricted and unrestricted income on the face of the income statement. It could also result in additional disclosure on the face of the statement of financial position or in the notes to the financial statements. Alternative 3 builds on Alternative 2 and adds a new requirement to provide supplementary donor or project statements for material funds or projects. This supplementary information could be part of the financial statements or form part of the notes to the accounts. This information could be on a cash or accrual basis. This proposal goes beyond existing requirements globally, but has the potential to meet the reporting needs of major donors. We want your views. The more views we receive, the better informed we will be for the next phase of this project. The consultation paper includes a number of specific matters for comment. The specific matters for comment relating to the presentation of financial statements cover the description of financial statement presentation, whether the list of alternative treatments is exhaustive, your preferred alternative treatment, and whether you agree that the term Statement of Financial Performance should be used. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future. Share your voice. Submit your response.